Let me now bring on board Manish Kumar, Chief Investment Officer and EVP with ICICI Prudential Life Science Insurance. Manish, morning. What a delight to have you back on ET Now. Glad you could accommodate this interview request. Manish, at a time when the broader call on valuations is that Indian markets are looking attractive, if I map what domestic institutional investors and what insurance companies have done for this calendar year, they may net sellers. Why is that?
I presume what insurance companies are doing is not just a function of the flows in the quarter, it is also a function of the views at that point in time. It is also a function of the behavior of the markets during the period. So if we have to go back a little in time, say in the previous 9 months or the first 9 months of the previous financial year, insurance companies were net buyers to the tune of about $4 billion. That was also the time when foreigners were net sellers. Whereas in the first 3 months of the last financial year or the current calendar year, foreigners were buyers to the tune of $9 billion. So possibly what insurance companies have done is they have actually booked some profits on the purchases that they have made in the previous 9 months.
And what's been your portfolio strategy at ICICI Pru for this calendar year? Have you been a net buyer or are you a net seller?
The current calendar year, we would have been sort of neutral as far as the markets are concerned. So you can say there have been some element of churning in the portfolio. So on the rallies in the months of February and March or late January, we were sellers. But in the last 1 month, we have been somewhat buyers. So as such, it has been a bit of churn here and there. But as you are aware, we tend to take slightly long-term calls. And therefore, if we look at our portfolios, most of our holdings that were existing as our top exposures 3 or 6 months back, they continue to remain so.
So Manish, elaborate on to what have you been accumulating in the last month?
See, there have been, actually, you can say there have been certain sectors and certain stocks, very stock-specific accumulation that we have done, like for example, stocks in the technology space, stocks in the commodities space, but not all commodities, but say those that are a play on resources like coal. Then certain, I would say, housing finance companies. So these are certain stocks that we have accumulated, and likewise in the previous rally we had actually sold some of the high beta stocks in the sector.
So at the current juncture, what is your market call? Do you think at these levels Indian markets are fully priced, and given the kind of global environment we are in for next 6 months, we are likely to grind in a tight range?
As far as valuations are concerned, I think it will be inappropriate to say that they are fully valued. Actually, they are quite fairly valued, or I would say marginally, or I would to some extent slightly undervalued. So as far as the valuations are concerned, we are quite comfortable with the valuations. Unfortunately, the triggers are missing. We require probably a more stable policy environment. We require interest rates to come down substantially. Marginal reduction in interest rates will possibly not help. We require liquidity in the banking system to improve. So as far as the valuations are concerned, they are quite comfortable, yet the markets are likely to remain range bound unless we see improvement on the domestic fundamentals.
Manish, when you say domestic fundamentals, do you think in the near term it's the currency weakness which is the largest deterrent for equities?
The currency weakness is definitely one of the deterrents in equities, but we need to understand why that weakness is happening and what the factors that are impacting that behavior. So it is basically on account of the high trade deficit that the country is running continuously, and historically, while we have always had trade deficit, it used to be not so high, and it used to be compensated by capital inflows, which was again a function of the domestic growth paradigm. Now in the last 1 year, we have seen continuous slippage in GDP growth. The investment climate no longer remains as attractive as it was say 2-3 years back. The policy consistency is probably missing, and the domestic tightness continues. As a result, capital flows have not been strong in the last few months, barring the first 2 months of the calendar year. And at the same time, trade deficit is running at almost 4%, or rather current account deficit is running at about 4% of GDP. So with that kind of current account deficit and weak capital flows in the last 1 or 2 months is causing this kind of behavior in the rupee. Unfortunately, what also happens is when the rupee starts weakening, it leads to more and more investors going out of the system or the markets. So they would like to wait until the rupee stabilizes before they take a call of investing back in the markets.
Manish, you outlined a perfect, stormy scenario for us. So at a time when things are bad, globally things are sticky, locally nothing is moving, margins are coming under pressure, revenues are also looking challenging. Does it make sense to be a buyer in stocks?
That is what we as long-term investors do, and that is what we are doing in the last 1 month. So yes, there are challenges on the horizon, and things may not look very good from a 3-month or a 6-month perspective, but then that is how things were looking 6 months back as well, and yet we saw a fairly good rally in the first quarter.
So what, Manish, according to you, would be the big trigger that is going to lead to the next leg of that rally that you just talked about?
While we have been worrying of late on what is happening globally, according to me, our markets have been challenged more by domestic factors than global factors. As I mentioned some time back, we need some policy consistency. We need fast tracking of the projects that have been stuck by environmental issues. We need liquidity in the banking system to improve. We need interest rates to come down decisively. And all of these factors would drive capital flows back into the country. And that would again mean an appreciating rupee environment, or at least a stable rupee environment, which would hopefully drive the stock markets northwards.
If I look at your last declared portfolio, some of your top key holdings are HDFC Bank. You have a large exposure to other private banks also. What's the logic behind buying private banks?
The private sector banks is one area where we have been historically overweight, and that has really helped us in the past. And if you look at the profile of growth in these banks, they have grown faster than the banking sector, and banking sector as a whole has grown faster than the India's GDP. And in portfolio management, where our job is to deliver outperformance, we believe that this is one space that will continue to deliver outperformance on a long-term basis. Yes, there could be challenges from time to time depending upon the challenges in either the corporate or the retail segments, but as such, on a long-term basis, we would like to be positive on this space within the banking sector.
At a time when GDP is slowing down, private sector capex is at an historic low. Does it make sense to buy banks, because banks again are a proxy to economic growth?
In a way, you are right, but as you read the names, you would realize that our exposure is more towards those banks that are a greater play on retail growth than corporate sector growth. So somewhere we are saying that yes, GDP growth is slowing down, but within that, the investments component is slowing faster than the consumption component, and these are some of the banks that are more a play on the retail growth, and therefore the decision to be overweight on those banks.
So how are you planning to play the consumption theme? Are you planning to play the consumption theme via banks, which, like you said, they are a proxy to retail growth? Are you investing in autos, again, which is dependent on discretionary spending? Or you're keeping it simple and you're buying FMCG stocks, classic defensives which touch the consumer on a daily basis?
As you can make out looking at the portfolio, while ideally we would have liked to play the consumption sector through the FMCG space as well, the valuations don't give us much comfort, and therefore we have chosen to be extremely selective while playing the consumption space through the FMCG sectors. Apart from the FMCG space, the other sectors where we are participating in the consumption space is basically the consumer discretionary or the auto segment. Within that, preference for the four-wheeler segment and the private sector banks and some of the housing finance companies.
Manish, you talked about your preference towards the IT space. Is your tilt towards the mid-cap IT universe, the likes of an Hexaware or an Oracle software, or do you think it's the blue chips which find favor with you, the likes of an Infy and TCS even now?
When I spoke about the IT space, what we spoke about was what we did in the last 1 month or so. In terms of preference for the IT space, what we are saying is that IT is one sector which is a beneficiary of the currency depreciation, but otherwise the business is coming under pressure, and therefore as a fundamental call, we would like to keep taking tactical calls from time to time rather than being overweight on this sector as such. So if you look at the portfolio, actually we are slightly underweight on the IT space, and that actually has helped us.
Manish, what drives the market in the near term, in the medium term, is liquidity. And Indian markets are completely dependent on global liquidity, because this year foreign institutional investors have pumped in about $9 billion. Retail investors are out, HNI investors are not present, and domestic mutual funds are selling. So my question is that if global liquidity dries up, what will bail us out? What will drive this market?
If global liquidity dries up, I think our markets would probably remain range bound, and it would probably continue to drift sideways. At the same time, if you notice, we are also not seeing any significant selling either from global or domestic investors, and therefore for lack of selling, and also because of the fact that the positions are not really very high in the markets, we would probably drift sideways, and therefore the onus on the portfolio managers would be to take stock specific or sector specific calls and probably do some rotation and try to add some alpha to the portfolio.
Manish, so what is your big call for FY13? I want to hear it from the horse's mouth, from someone who manages about $6 billion of direct equity exposure, which is certainly one of the largest in India.
As far as equities are concerned, I said that as far as equity markets are concerned, probably it is going to be sideways for the next few months. But as far as the sectors are concerned, we would like to be overweight on consumer discretionary and private banking space. These are the two spaces that gives us maximum comfort.
Why are you bullish on autos at a time when inflation is high, interest rates are high, Indian consumer is confused, and salary levels have been static? What do you think will drive consumption?
Well, what we are looking at are those indicators or those things which are sentimentally damaging. And yes, they are going to have a bearing on the auto numbers in the next few months. But what we are looking at is what is a structural trend. And in this country, where right now our per capita income levels are at about $1,500 US, if I have to take a 3 to 5 year call, four-wheelers is one space that is going to do very well. Secondly, interest rates have peaked, and while they may not come off very significantly in the next 1 or 2 months or 3 months, yet if I have to take a 2 or 3 year call, I think interest rates have to come down decisively, and this sector does not suffer from any potential asset quality issues that the banking space suffers from. Also, when we are talking of global slowdown, then what we need to understand is probably commodities as a space will remain range bound, or the commodity prices would remain range bound, and if that were to happen, then at some stage we will start seeing the benefits on margins in the auto companies.
Manish, what about the policy front? I mean, we've seen a bold move from the government by way of the petrol price hike, and a very steep one at that. Could we see the same kind of hike coming in for other, oil and gas products too? For instance, diesel, or do you think that's going to be a very tough call for the government at this point in time?
Relatively, it is indeed going to be a tougher call, and that is something that the markets are going to watch very closely. I have to say that this was one bold step that the government took, but at the same time we have to be cognizant of the fact that while the quantum of hike is very big, it does very little to address the fuel under recovery. Probably the benefit is to the tune of just about $500 million, so it's not a very big number, whereas every rupee hike on diesel or LPG can have a much bigger impact, and therefore that is something that is going to be closely watched.
Manish, valuations one side, but what ultimately drives any market is earnings. So if I look at the global setup or the local setup, what will drive earnings? Commodity prices are high, global exports are slowing down. Like I said, Indian consumer is getting exhausted. What in corporate India has reported for the quarter gone by is a squeeze in margins and a dip in revenue. So what will drive earnings now?
In fact, we are also calling for a slowdown in earnings growth momentum. So there was a time when earnings growth used to be of the order of 20% plus. We are no longer calling for that kind of earnings growth. But then that is also the reason why the valuations are becoming so reasonable. So if the earnings growth momentum were as high as during the period, say, between 2004 and 2007, our markets wouldn't have been where they are today. So somewhere, whenever we are looking at markets, we look at earnings growth or valuations in tandem. So if the earnings growth is going to be muted today, which is going to be probably of the order of high single digit or low double digit, so is the valuations. So the ultimate call is that 1 year or 2 years down the line, as and when the interest rates will come off, as when the commodity prices will stabilize or come off because of the global slowdown, the margins of the companies will start looking better, and the PBT margins will start looking even better because interest as a percentage of sales will start coming down. So somewhere it is about taking slightly medium-term call.
Manish, I know you have a mandate to invest, and as a fund manager, you have a compulsion that you, by and large, you have to always remain invested.
Right.
You know, but over the years I've known you, you've always been an optimistic person, but right now you're sounding rather tentative and nervous to me.
I don't think we are nervous about what's happening in the markets. We are just trying to say very frankly and very honestly that we expect markets to be range bound, and in fact that has been our call for the last 18 months or so. So we have always been maintaining that our markets are likely to move sideways. Plus minus 10% for us is like a range bound movement, and that is what we've observed in the last 18 months or so, and probably that is what is going to continue to happen in the next 6 months. In fact, there have been times when people have been extremely bearish, and yet if you look at the markets, they haven't really fallen so much in terms of index, and that is what probably is going to happen.